equity. A little bit laggy here, but is it a little bit laggy on your end now? And it's pronounced Noah, correct? Not no. All right, let's see here. 1 second. Hopefully as this thing gets going, it'll stop being so laggy, but we'll see here. Let me just confirm on YouTube here. 1 second. What's up, everyone? Welcome to tonight's Sunday macro wrap-up. Hope everyone is doing well. Lots of stuff to talk about today. I know that for some reason my computer just continues to be laggy. I think it's just because I'm running the streaming software as well as Zoom at the same time, so I think that's what's causing a little bit of a lag here, but we'll continue, and if it's too much of a distraction, then you guys can let me know. But let's see, how's everyone on Instagram? Can you hear me okay? Is it coming in laggy? Is it coming in all right? Put a 1 in the chat if you guys can hear me okay. Same thing with TikTok. All right. Welcome everyone. For people on the Zoom chat here from our group, let me know if you guys can hear me okay, because I know it's a little bit laggy right now. Gotcha. Okay. All right, we're good to go. Okay, so welcome to tonight's Sunday macro wrap-up for March 2nd. It's the first Sunday macro wrap-up in the month of March. We had a pretty exciting February. Obviously the market had a little bit of a down time in February, and there was a very large pessimistic sentiment among investors, which, I mean, is understandable, but it's quite hilarious how, we're only, 5% from all-time highs, and we received the most bearish reading in investor sentiment in a couple years. And so that is pretty notable there, but we're going to be going ahead and, pretty much the structure of these Sunday macro wrap-ups is that they're an hour long, give or take. The first 30 minutes is streamed so that we can cover all the different topics. And then also after the 30 minutes, we're going to close it off from Instagram, TikTok, and YouTube. So we're going to cut it off from the public and just go to the members who are joined live here on our Zoom call. And then the last 30 minutes, we'll actually go over actionable ideas and answer any one of your guys' questions. And we will reserve those just for the members in there. So for those who are joining live, if you guys want more information on that, then you can just go to the link in my bio there and check out the 7-day free trial for our macro investing community. All right. So we're going to go ahead and get started here. Last week, it was pretty much a scared growth week, right? So last week, there was a lot of fears amongst, even though with the improvement in inflation data, there was a lot of fears with growth slowing too fast. And we'll get into some of that here. But the first metric that came in that was not such a good reading was the Consumer Confidence Index. This is from the Conference Board. This is considered a leading economic indicator, and it is essentially a survey across a bunch of different types of consumers who respond to these surveys, and it also talks to some businesses as well. But essentially, there was a large drop in the consumer confidence reading. And so that, in conjunction with some of the retail metrics that were also decelerating, it's really showing a picture that the consumer isn't doing as well as everyone thought. And with consumption being, over, or it's nearly 70% of the entire GDP number, obviously the consumer, the state of the consumer, as well as consumption metrics are a huge deal. And you have to also remember that we're seeing a trend in services consumption start to decline while manufacturing starts to rise. And so with 70% of the consumption measure being services, that is quite interesting there, as well as a difference from the past 2 years where services has really held up great. And so we have to pay attention to this. So that was the first metric. That was on Tuesday. And then on Wednesday, we saw that we had an acceleration into positive territory with U.S. Durable goods new orders. Now, this is another leading economic indicator taking a look at manufacturers with their new orders, right? So if there's a lot of demand, then you look at durable goods orders to be like, okay, manufacturing, they're getting a lot of orders. That's actually good for the economy. Manufacturing is looked at as a leading economic indicator because they are highly sensitive to rate expectations, as well as the coincident indicators with what interest rates are doing. But we know that this was mostly because a lot of manufacturers are getting ahead of the Trump tariffs that go live this week. And so despite this, we received the first deceleration in the personal consumption expenditures, as well as some other inflation data that we haven't had in quite some time. And so as we see, this is core PCE prices. So this is the Fed's preferred inflation measure. This actually had a fairly large decline to, levels that we really haven't seen, since June of 2024. And so with that being a positive note, right, because you want inflation coming back down to the Fed's 2% target. The reason why it was more of a scare was because obviously you're having a larger deceleration in growth. And so, taking a look at the Cleveland Fed's CPI inflation forecast for the month of February that gets reported in the second week of March, you can see that across the board with CPI, core CPI, PCE, and core PCE, across the board, there's decelerations. Hold on one second. There we go. Thank you, David. So, taking a look at that, I would not be surprised, as well as with commodities, when you take a look at the CRB commodity index, so the prices of inputs in the economy, that has also been decelerating since its peak on February 20th. So last week there was a very large deceleration in commodity prices, and so as well as oil too. And so with a lot of these inflation, not only leading but also lagging indicators pointing to a deceleration, that is good news on the inflation front. And I would not be surprised if we had a lower inflation number. And so from here, if we see a rebound in growth, as well as that inflation continues to decelerate, then what you'll start seeing is more of that soft landing narrative come back into the conversation, which is really what Wall Street, as well as the stock market, as well as cryptocurrencies are looking for. And so if that tends to happen, then I wouldn't be surprised if we continue the bull market. But of course, last week we had the big news, which was the United States trade deficit decelerated to $153 billion. And this was a large deceleration from the negative 122 billion that we saw in December. And this was mostly driven from manufacturers, again, getting ahead of these Trump tariffs by having a bunch of new orders up front. Just like if, let's say your local grocery store was like, hey, next month, the price of, I don't know, I don't know, anything, juice is about to go up next month by double. So what are you going to do? You're going to go out and let's say you like to drink juice. You're going to buy a lot of juice. You're going to stock up. Well, that's exactly what the manufacturers are doing here with a lot of their different durable goods. And so what this could be is if this is an overreaction when we come to see everything come to light, then you could have a very aggressive V-shaped bounce back in stocks and crypto because essentially, let's say, the tariffs get enacted and it's not as bad as what, the market is expecting. Or, the tariff situation is more in line with Trump's first term when he enacted tariffs, which again, when Trump first did tariffs during his first term, they weren't inflationary at all. And so what's really caught hold is the inflation numbers from December and January, which were accelerating, but now they're decelerating. What you could have is just a snapback rebound in a lot of these different things that have sold off. Now, the sell-off was so aggressive last week that we did, take some things bearish that we normally didn't have beforehand, like Bitcoin as well as the Nasdaq, which we'll get to the charts here in a second. But I am not, weighing out the fact that we could have a snapback rebound if the market sees that this tariff stuff isn't as bad as they thought. And so that's the macro data that I'm really paying attention to. Because if that does happen, you do not want to miss out on that snapback. But essentially, this trade goods imbalance caused the Atlanta Fed's GDP nowcast to drop off to a negative, negative 1.5% for Q1 of 2025. And so again, this was another, really big negative headline that came out because of the distortions with this trade imbalance. Because you have to remember the formula for GDP is you have consumption plus investment, plus plus residential fixed investment, plus commercial investment, plus government expenditures, plus exports minus imports. And so when you have imports accelerate, that's subtracting from the GDP number. And so that one component caused this to really decelerate here. And so whenever you go to the Atlanta Fed's GDP Nowcast publish, you can go to where that says the model is available here, and it pulls up this slide sheet where you can go down and scroll to where it has a little bit more detail of what each component is, right? And so just like we talked about, we have PCE, so this is consumption, we have equipment, non-residential, residential investment, government spending, exports, and imports. And so what you can do is instead of kind of, getting all jumbled up with all these numbers, you can come on down here to this little box here, right here, and just look at the difference between the beginning of the month of February to the end of the month of February. And so as you can see, the largest decelerations were in consumption. So that went from 4.1 to 1.3. You also had a fairly large deceleration in residential investment. Or I'm sorry, this is non-residential, so this is commercial investment. Same thing with residential as well. But as you can see with imports, that was the largest increase. And again, when imports increase, that is a subtraction factor from the GDP number. And that's really what was causing this to go negative. But you cannot ignore the fact that we did have a large deceleration in consumption. And that's the big thing that I'm looking at because, again, it's 70% of the entire GDP number. So even if we have a rebound where things kind of normalize with the import situation, and we start to actually have more of a trade surplus from here, it's still a deficit, but less of a deficit. So a deficit recovery. Then you could see a bounce back in growth or just a stagnation effect, right? And so that's not a surprise because when you take a look at the 10-year U.S. government bond yield, which again we'll get to in a second, you can see that that's been going down. And so the 10-year is a reflection of the bond market's future expectations of growth and inflation. And so with it decelerating, that's good for rates. That's actually the market easing, but it's also trying to price in the slowing growth. And so ultimately, when taking a look at the Fed meeting, which is later this month, it's on the 19th of March, despite all this, there's still a 95% chance that they're going to continue pausing. So there's a 95% chance that they're going to leave rates where they are and not cut. And so that means we have to move out to the different Fed meetings. May 7th is the next one after this March meeting. That still remains at a 71% chance that they still don't cut. So now we get into March, April, May of us still being at the same rates. And then in June, that's where it really drops off. So that's where you have now an over 57% chance that they actually cut by 25 basis points. And then after that, there's chances that they cut even more from there. And so really, the bond market is pricing in the first rate cut for June of this year. And so we'll continue to monitor that, but you still have 5 full months. March, April, May, and then half of June. So really, 3.5 more months of rates of where they're at right now. So there's still that 3-month window where you could have some more volatility while rates are remaining higher. Despite rates remaining higher, you still have, from a lot of the Biden stimulus with the deficit spending, you still have both financial conditions extremely loose. So both the Chicago Fed National Financial Conditions Index, as well as bank credit year over year, had a large acceleration last week. That was quite notable. You're still seeing pretty loose conditions in the banking sector. Now, going back to what we were talking beforehand with the 10-year U.S. government bond yield, which is, again, where everyone is actually borrowing, we're going to continue to see the 30-year mortgage rates, as well as credit card rates, all those other things. We're going to continue to see those decline as the 10-year continues to decline. From here, going on to earnings, obviously last week we had earnings for NVIDIA. That was the big earnings call, last week that got headlines, and it had an initial pump. NVIDIA did, and then it had a deceleration. We talked about that on this channel, where we talk about the slowing in the positive revenue. And when you take a look at that, we call it the 2-year stacked growth. It's not what we call it. It is what it is. It's just another derivative form of looking at the trends. But as you can see, I have the revenue, gross margin, expenses, net income, and earnings per share for NVIDIA. Why do we look at NVIDIA? Because it's one of the biggest stocks in the S&P 500, and the entire world is invested in it. So that's why we track it so closely. But as you can see, look at revenue from Q4 of fiscal year 24. Now this was reported in January of 2024. And so that was at 265% year over year revenue. If you guys remember, that was like this time last year, the month of December, January, and February, I think, and March were all 4 of those months were really good for the stock market. And because, look at, a lot of these earnings, even Q1 of fiscal year 25, that was at 262%, a slight decrease. But then look what happened. Q2, it went from 262 to 122% year over year, from 122 to 94. And then just recently from 94 to 78%. And so the reason why we look at the 2-year stacked growth is because for the fiscal year of 2024, for Q4, it went from a 265% year over year down to 78% year over year. And so that's the deceleration that we're talking about when looking at NVIDIA. And so when we look at the 2-year stacked growth, you can see that the slowdown is more and more pronounced here, right? And so that's what we're looking at when we're talking about how these big mega caps are slowing down. Now, we'll continue to monitor NVIDIA, but if this continues to slow down, obviously that's going to be a headwind for the market, even if we do have this volatility continue. And so this is just one thing that we have to track. But obviously, we've had 1, 2, 3, 4 quarters of NVIDIA slowing, and it seems to be slowing at an accelerating pace in terms of the amount of revenue they're generating. And the reason why you're getting positive headlines is because the news only cites what they expect, and if they beat the expectations. They don't really talk about this type of model here. And so I highly recommend that you guys keep track of this yourself. It's really easy. It's nothing fancy. It's just tracking it on a chart here. I think TradingView also allows you to do that as well, but I highly recommend it. And then lastly here from last week, check out this. So the American Association of Individual Investors had their sentiment survey last week, and the bullishness was at 19.4%, which was the lowest since March of 2023, and it was among the 65 lowest bullish readings since 1987. And then for bearishness at 60.6%, that was the 7th highest weekly reading on record. And we're still, near, within 5% of all-time highs, which was incredibly interesting. Yeah, when you take a look at the spread between bullishness and bearishness, look at this huge drop-off. I mean, it's incredible. So the investor sentiment is incredibly bearish right now. And then when comparing to money managers and people who actually are in the financial sector, actually managing money for people, they're not as bearish, but they did have a slightly bearish undertone, but they're pretty much neutral. But it is very interesting how you would have a squeeze here just because everybody is bearish. So that's definitely interesting there. Now, taking a look at the week coming up, we have a pretty big week. The first week of every single month is always Labor Data week, as well as ISM manufacturing and ISM services. And so really the big 3 days are Monday, Wednesday, and Friday of next week. Tomorrow, we receive information on ISM manufacturing. And so we'll continue to pay attention to if we see an acceleration, not only in prices, because remember last time we saw prices increasing, we saw new orders decreasing, and then we also saw employment decreasing. So we want to see if that continues in this report. So that would be the 3 components that I look at. Again, prices, new orders, and employment. And then on Wednesday, we have the ADP non-farm employment changes. So there's 2 employment reports. There's the ADP, which is a private group, and then you have the I think it's the census, right? No, the Bureau of Labor Statistics. My apologies. So you have that one on Friday. And then also on Wednesday, we have the ISM services PMI. So same thing. We want to still see if there's a deceleration in the services sector. We also have challenger job cuts. We also have average hourly earnings and the unemployment rate. And then Fed Chair Powell speaks on Friday at some type of conference. So we'll be taking a look at that as well. And then just taking a look at the other big things this week. Next week the following week is inflation CPI. And then the third week in March, we have the FOMC press conference on Wednesday, the 19th. So that's the second Fed meeting of the year. So we'll be live streaming that on our socials. And then the last week of March, typical, from what we normally see, core PC at the end of the month and flash manufacturing and services PMI. So that's what I'm looking at here. But in the spirit of the first week of the month being Labor Data week, we can take a look at the 4-week moving average of initial jobless claims. And those have been trending down here since it had a local peak on August 3rd of 2024. And then it continued to decelerate, but it did have a pop last week. So we want to pay attention to that, but we have seen pretty much a deceleration since August. But again, since this next labor market report will be from data that was collected in the month of, I think it's the month of February, correct? Let me see here. 1 second. Let me go to... Bear with me here 1 second. Okay, yeah, so we get it for January data. Is this adjusted weekly? Let me see something here. Okay, yeah, so it would be for the month of January being reported. So that's what we will be paying attention to coming up this week here. Now, going over to the charts. Obviously, on Friday, we had a pretty decent buy or pretty decent rebound in the S&P 500 back, into, I would say, neutral territory, but it was on larger volumes. So that definitely is a good sign there. NASDAQ remains bearish trend, though. So that is notable. We'll see if it bounces back. Again, we do have to see what happens with, if we start to see a rebound in a lot of the growth data as inflation continues to decelerate. That is what Wall Street is looking for. So we could have a change. But what I really wanted to see when we went live on Friday was I really wanted to see the VIX close below 20 into the 19s, which it did. And so that, to me, is a pretty good sign that we saw that there. Taking a look at the U.S. 10-year government bond yields, as we noted, this remains in bearish trend. We are now bullish on bonds, right? So these are things like IEF, TLT. Those are the ones that hopefully you've made a position in already. It's already at the top end of the range, so I wouldn't be chasing green here in bonds. I would wait for a bit of a bounce in bond yields. Remember, bond yields and bond prices are opposite. So yields down, prices up. And so now that it's at the low end of the range, you'd probably want to see a bounce maybe to like 4.3 before you add. Oh, I'm sorry for the people who had joined via Zoom here. Thank you, David, again. So taking a look at 10-year U.S. government bond yields, I wouldn't be surprised if this had a little bit of a bounce this week. So we'll be looking to, at that point, add at the top end of the range on bonds. The dollar does remain in bearish trend. Obviously, the dollar is one of the large important ones because as the dollar has been in bearish trend, you've seen a large outflow into foreign equities, things like China, Germany, DAX. Those have been things that have been doing very well over the past several weeks as the dollar remains bearish. And so we did have a bounce in the dollar last week. And so there were some opportunities in some foreign equities. So hopefully you guys were taking advantage of that there. And then pretty much the only things that remain bullish, or really Meta is the only mega cap that remains bullish as of this point. Microsoft, NVIDIA, Amazon, Google, and Tesla remain in bearish trend. And then commodities took a bit of a hit last week, but really, you'd want to make positions in things that are continuously in their bullish trend, like gold, as well as silver and copper. And then let's see here. Foreign equities, we're talking about opportunities. So the DAX, which is Germany ETF, that had a bit of a sell-off last week. So our group was buying the dip as that was happening there. And then let's see what else. Let me go over to one of my screeners here. Yeah, the best performing international equity ETF last week was Kuwait, KWT. So that had a pretty large acceleration, and that's been in bullish trend for quite some time as well. But Kuwait had a very large pump there, and then yes, as well as China. Or I think China actually had a bit of a sell-off, so there's opportunities in China as well. Again, we'll talk about some of those opportunities here after we disconnect from the live stream and just have the members on the call. And then lastly, taking a look at Bitcoin. Obviously, everyone heard today, if you have an X feed and some eyeballs, we saw that there was a tweet announcement from the administration about an updated effort on the Bitcoin reserve. And so it's having a nice little bounce here to get out. Again, it remains in bearish trend, even though it did have this bounce here. So if you guys weren't able to consolidate, this is a great time to consolidate with Bitcoin as well. And so that is pretty much all I have for you guys here. Now, again, for those people who are joining on our live stream, if you guys want to partake in some of the actual ideas here, if you guys want to join the call, you can go to the link in my bio and start your 7-day free trial, and you guys can join that there. But we're going to go ahead and close it out on the socials and then go into the group here. So we appreciate everyone for joining here. If you guys have any questions, feel free to send me a DM for my team to respond to you. And then, yeah, good luck out there, and I will catch you guys tomorrow. Those who are staying on the